There's a strategy I see quietly used by high net worth retirees all the time. Doesn't show up in headlines, it's rarely discussed in casual retirement conversations, and most people never hear about it from their advisor. Not because it's a secret, but because it only makes sense once you reach a certain level of wealth, and once taxes, income planning, and legacy all start colliding at the same time. Talking about the Charitable Remainder Trust. When used correctly, this strategy can eliminate capital gains taxes in the year you sell an appreciated asset, create a predictable income stream, and support charitable goals without sacrificing retirement security. When misunderstood, it can create a confusion, unrealistic expectations, or unintended consequences. So today, let's walk through how charitable remainder trusts work, why high net worth retirees use them quietly, and just as important, who they're not right for. Hi, I'm Jason Solomon. I'm the president of Tactical Investment Advisors. Today, I'm going to break down the Charitable Remainder Trust, how it works, why some high net worth retirees use it, and a few things to understand before assuming it's right for your situation. If you find this video helpful, please like, comment, and subscribe. It helps more people find these educational videos. Part 1. Why taxes become a bigger problem at higher net worth levels. One thing most people don't realize is that as wealth increases, taxes often become the largest planning challenge. Not market risk, not spending, taxes. High net worth retirees often face large embedded capital gains, highly appreciated assets, concentrated stock positions, real estate with low cost basis, and business sales. Selling these assets outright can trigger significant capital gains taxes, sometimes all in one year. And once those taxes are paid, the flexibility's gone. This is where structures like Charitable Remainder Trust enter the conversation. Part 2. What a Charitable Remainder Trust actually is. At a high level, Charitable Remainder Trusts, often called CRTs, is an irrevocable trust that provides income for you or your beneficiaries, removes assets from your estate, and ultimately passes assets to a charitable organization. Here's the basic structure. You contribute an appreciated asset to the trust. The trust sells the asset. You receive an income stream for a set period of time or for life, and at the end, the remaining assets go to a qualified charity. The key detail is this: the trust, not you, sells the asset. That distinction changes how taxes are handled. Part 3. Why capital gains taxes are the main driver. One of the biggest reasons retirees explore CRTs is capital gains tax management. When appreciated assets are sold personally, capital gains taxes are triggered immediately. Inside a charitable remainder trust, the sale can occur without immediate capital gains tax. Taxes are recognized gradually over time as an income distributed to the beneficiary. That doesn't mean taxes disappear. It means taxes are spread out over time rather than compressed into one large event. For retirees with highly appreciated assets, that difference can materially improve after-tax outcomes. Part 4. How the income stream works. A CRT isn't about giving assets away and hoping for the best. It's designed to create a defined income stream with distributions that may be taxable. Depending on the structure, income may be a fixed dollar amount or a percentage of the trust value. Income can last for life or for a specific amount of time. Payments are defined by the trust document. Predictability is part of the appeal. This can be especially attractive for retirees who want steady income, who don't need full access to principal, and who prefer predictability over flexibility. It's important to understand this income is governed by the trust rules, not by market whim or personal choice. Part 5. The charitable component and why it matters. Eventually, the remaining assets in the trust go to charity. That's not a side benefit, that's a core feature. CRTs are best suited for retirees who already have charitable intent, who want to leave a philanthropic legacy, value impact as part of their planning, and want children to manage a charity created from their life's work. This is why they're often used quietly. They're not about maximizing personal wealth at all costs. They're about aligning income, taxes, and values in a single structure. Part 6. The tax deduction most people miss. One thing many people don't realize is that contributing to a CRT may generate a charitable income tax deduction. And that deduction is based on the estimated value that will pass eventually to charity, IRS actuarial assumptions. That deduction may be used to offset income, subject to applicable limits and rules, of course. This can be valuable in years with unusually high taxable income, but this is where precision matters. CRTs are not plug-and-play strategies. They require careful modeling and professional coordination. Part 7. Why this strategy is not for everyone. CRTs are powerful, but they're not universal. They may not be appropriate if you need full liquidity. You may need access to principal later. Your net worth doesn't support the irreversibility, or you have no charitable intent. Remember, a CRT is irrevocable. Once assets are transferred, they cannot be taken back. This is why CRTs tend to be used by retirees who have excess assets. They already feel financially secure. They want to optimize, not stretch outcomes. Part 8. The CRT planning mistake that I see most often. The biggest mistake I see is people learning about CRTs in isolation. They hear capital gains deferral, income stream, charitable impact, and then they assume it's a silver bullet. But CRTs must be evaluated alongside retirement income needs, other tax strategies, estate planning goals, healthcare and longevity considerations. They're a powerful tool when they're used correctly. Used poorly, and they can create a financial disaster. Part 9. How net worth retirees actually use CRTs. So in practice, CRTs are often used to solve specific problems. For example, selling a concentrated stock position, selling a business, transitioning out of appreciated real estate, reducing tax exposure in a high-income year, creating lifetime income tied to a charitable goal. They're rarely used in isolation. They're used as part of a coordinated plan. This is why working with a financial professional can make a meaningful difference. Part 10. A better way to think about the strategy. Instead of asking, is a charitable remainder trust good or bad? A better question is, do I have a tax problem, an income goal, and a charitable intent at the same time? When all three are present, a CRT may be worth exploring. When one is missing, other strategies may be more appropriate. Charitable remainder trusts could be complex. CRTs are about coordination. They exist at the intersection of tax efficiency, retirement income, and legacy planning. That's why high net worth retirees use them quietly. Not because they're a secret, because they're highly situational. When aligned correctly, a CRT can reduce your tax friction, create predictable income, and support causes that matter without undermining retirement security. When misaligned, it can introduce rigidity where flexibility is most needed. As with most advanced strategies, the value isn't in the structure itself. It's whether the structure fits your life, your goals, and the long-term plan. If you're approaching a liquidity event, retirement, or already retired and want to understand whether advanced strategies like charitable remainder trust actually make sense for you, let's talk. Tax planning, income planning, estate planning, and charitable goals all interact. Looking at any one of them in isolation is where well-intentioned strategies fall apart. When you book a free consultation using the link in the description below, I'll walk you through how these pieces fit together in your situation, so you can evaluate whether a CRT is appropriate, unnecessary, or something to revisit later. There's no pressure, there's no obligation, just a clear professional conversation focused on helping you make informed decisions with clarity and confidence. Click the link in the description below to book a free consultation. I'll walk you through your options. Thanks for watching, and if you found this helpful, I'll see you in the next video.